What's up everybody, welcome to my channel. Today I have a really good one for you. I will be sharing with you 5 dividend paying ETFs that pays dividends monthly. Yes, you heard that correctly, monthly paying dividend ETFs. So I've picked out 5 ETFs which I believe are the best in my opinion, that will give you the best bang for your buck. So let's start wasting the time and get right into it. So the first one on the list is DHSR Wisdom Tree USI Dividend Fund. This ETF seeks to track the investment results of the high-yielding dividend-paying companies in the United States. So in other words, you don't have to be wasting your time to do research to try and find stocks with high dividend yield. You could just invest in these stocks and the ETF will take care of all of that for you. So this ETF is just giving you exposure to the highest dividend yielding companies in the United States. So for example, out of this 315 stocks which this ETF holds, some of the top including names that you might be familiar with like Pfizer, Coca-Cola and AbbVie. And because this ETF has some solid companies in it, the performance for the last 10 years has been really good as well. It has an annualized return of 11.2% for the past 10 years. So this means that if you had invested $1,000 10 years ago, your investment would have grown to approximately $3,000. And on top of that nice growth, you'll also be enjoying some nice dividends of 3.65%. So that's the dividend yield for DHS. And for a dividend ETF that has performed that good, it has an excellent dividend yield. That 3.5 is a must-have. Now you might be thinking to yourself that MR 3.65% is not that impressive. There are stocks with dividend yield as high as 8%. So for example, you could go with a stock like Presto that has a dividend yield of 7.8%. But while that dividend yield is mouth-watering, this growth of the stock has been stagnant over the years. It has not performed any at all. And in this case, you'd get caught in what is called a dividend trap. You'd be investing in a stock where the dividend yield is so high and nice, but you are not benefiting from no capital growth at all. Now the expense ratio for this ETF is not the most expensive or the cheapest in the world. It has an expense ratio of 0.3%. This means that you'd be paying $3.08 per $1,000 invested per year. So generally I'd say that anything that falls below the 0.5 percentage mark for expense ratio would be considered as cheap to an extent, even though you have way cheaper than that, but 0.5 is a fair go. Coming in at number 2, we have SPHD, also known as Invesco High Dividend Yield S&P 500 High Dividend Low Volatility ETF. Pretty long name, right? SPHD is based on the S&P 500 Low Volatility High Dividend Index, which is pretty much an index that measures the least volatile companies that are high dividend yield paying stocks in the S&P 500. This index was basically designed as a benchmark for investors who are looking to earn from their investments. Because SPHD was designed around this index, it's pretty safe to say it would be a good dividend fit for your portfolio. So SPHD currently has a holding of 51 stocks, with top holdings being Iron Rock Mountain, Altria Group, and company like AT&T. Others you might not be so familiar with. So this ETF was founded in 2012, so we can't really get a 10-year performance. So the end of this year, which is 2022, then you can get a 20-year performance from that stock. However, since its inception, this stock has a solid returns of 11.03% annualized. So this means that if you invested $1,000 back in 2012, your investment would have worth a little over $2,500 today. And remember now, the market is down overall about 20%. Considering that this is a high dividend yield ETF, it's really impressive to see that you would have benefited from such capital growth while receiving those sweet dividends. So the dividend yield on this ETF is 3.6%. And if you don't know what dividend yields are, I encourage you to check out my video on dividends. I'll leave a link to that in the description below. So the expense ratio for SPHD is 0.3%. So the expense ratio for SPHD is 0.3%. This means that you'll be paying $3 for every $1,000 invested every year. Wouldn't be that nice if you're just paying somebody $3 every year. If for $1,000 that they are giving you 10% on, plus a dividend yield of 3.6%, for me, if you're an income investor, that's a good deal. So next up at number 3 is PGX, or the Invesco Preferred ETF. Now PGX seeks to track the performance of the ICE Buffet Core Plus Fixed Rated Preferred Securities Index. Boy, this one is really a long name. I'm wondering who came up with it. So PGX basically invests in preferred stocks, which is a special type of stock. And now PGX basically tracks preferred stocks, which is a preferred type of stocks. It is different from common stocks. I'll leave a link to a video which explains that in details in the description below as well. So PGX all around 301 preferred shares, and these are particularly financial companies like JP Morgan. PGX all around 301 stocks with top holdings in companies like Citigroup, JP Morgan and Wells Fargo. And as you can realize, these are all financial companies, so preferred stocks are normally issued by financial companies. Over the past 10 years, PGX has returned an annualized return of 4.92%. This means if you have invested $1,000 10 years ago, you would have approximately $1,600, a little over $1,600 today. But on top of that, you'll be enjoying some nice dividend yield of 5.68%. However, the expense ratio for PGX though is a little bit higher than the previous two. It comes in at 0.51%. So this means that for every $1,000 you invest per year, you'd be paying $5.10 to have that money managed. That's simple what it means. Coming at number 4, we have DIV, or the Global X SuperDividend US ETF. DIV invests in low volatility, high dividend yield stocks across the entire US stock market, not just the S&P 500. Some of its top holdings include Ole Energy Partners, Smart Cubes, and Iron Mountain. So for this ETF, we don't have a 10-year performance because it was started in 2013. However, since its inception in 2013, it has an annualized return of 6.7%. While it's lagged the others in performance, it catch up in dividends. It has a dividend yield of 6.37%, which is the highest on the list so far. However, its expense ratio is on the borderline side. It has an expense ratio of 0.45%. This means that for every $1,000 you invest, you pay $4.50 per year to have it managed. Now you probably see a little trend going on. The higher your growth, the lower your dividend yield, right? So there will always be a little trade-off. So at number 5, we have SDIV, or the Global X SuperDividend ETF. Yes, it might sound familiar because we just spoke about it in number 4. They are made by the same company, but this one has a slightly different twist to it. So the difference between these ETFs is that DIV invests in the top 500 high dividend yield paying stocks in the United States, while SDIV seeks to invest in the world's 100 highest dividend yield paying stock. However, the actual number of holdings in this ETF is 104, with top holdings include Electra Consumers and China Dongxing. I'm really not sure to pronounce that China word thing though. And a bunch of other names you won't recognize. So for the last 10 years, this performance is not so hot like the previous one. It has returned 1.32%. That means if you had invested $1,000 10 years ago, it would worth a little bit over $1,140 today. Sounds pretty much like a savings account, right? But if you're investing for dividend, it would be a great addition to your portfolio nonetheless, because that's a dividend yield of 6.83%. So the expense ratio on this one is a little bit on the high side. It's 0.59%. That means for every $1,000 you invest per year, you pay $5.90. Remember guys, I'm not a financial advisor, so make sure you do additional research before investing in any of these stocks that I mentioned in this video. You can use platforms like Seeking Alpha, Yahoo Finance and ETF.com to do further research. I hope this video had some value to you today. Thank you for watching. See you in the next video.